Okay, so what I'm going to do is I'm going to go through the Education of a Value Investor by Guy Spier, and as it relates to investing in commercial real estate. And the reason I wanted to do this is just in conversations that I have with people that are kind of new to the world of commercial real estate, I think that what I'm taking away from this book is a couple of key distinctions. And the one theme is that what we learn at university or what you learn in terms of how to underwrite or even do a back of the envelope on a property, those technical skills are important, but frankly, they're fairly easy to get good at, right? It's not that difficult in when you compare it to actually picking a really good property to invest in. It's not that difficult to learn how to underwrite. So anybody that's joining, this is the book that I'm going to be talking about here. And so how do you actually apply some of these lessons, if you will, that Guy Spier learned from Warren Buffett, Charlie Munger, Manish Pabrai? And I think really what I want to focus on is that when it comes to investing, and I'm going to talk about it in the context of commercial real estate, that there's a lot of emotions and people that complicate the numbers, right? Because the numbers, the science of doing a back of the envelope on a property isn't difficult. But once you start to evaluate properties through different lenses, through different contexts, right? A property in Calgary versus Toronto versus Vancouver versus Denver versus, Edson, Alberta. I mean, all of these are going to have different variables that come into play. And really, it becomes an art in terms of reading between the lines. And I'll give you a good example. So let's say I'm looking at the T12. So this would be the trailing 12 months to understand and try to get a valuation on a property. And this is like a real world example because this was a property that we did probably in 2010. And it was a developer that was selling the apartment building. And what we looked at was like you just saw a steady incline of them, the developer that is, filling the property. Okay. What we didn't understand, or we didn't know until after we closed, is that the developer and the property manager were kind of working together to basically fill the property as quickly as possible. And they really were not screening for quality tenants. And because we had overlooked, because it as a line item, if all you looked at was, in this case, bad debt, and they actually had it kind of split out a few different ways, like bad debt and accounts receivable. The numbers were relatively small, but as a percentage, had we probably looked at it a little bit more closely, we would have realized that if you were to compare it to other properties in that area, in that submarket, that we were probably 3 to 4 times higher than the submarket. But we weren't comparing it to that. We just looked at it and said, that's actually an acceptable range for us in terms of bad debt. And we were comfortable with that. What ended up happening is once we got in, we realized that about 30% of the tenants should never have been there. So what we thought was a 90% full building, once you started to turn those tenants over or you realized that they really shouldn't have been there, we were probably closer to 60%. Okay. Now, that is the difference between just looking at the numbers and then truly understanding because of experience, because of, having done enough of these deals to really look between, read between the lines, if you will. I think that's a common phrase. And so one of the things that Guy Spier talks about is Manish Pabrai. And if you're not kind of in the world of value investing, I hadn't really heard too much about him, but he is, a lot of people compare him to Warren Buffett, just obviously a younger version and not nearly as well known, but an extremely smart guy. And excuse me, what Manish does is he is able to invest with imperfect information a lot faster than, say, Guy Spier. And the reason he's able to do that is because he has rules for his investing and he knows what it is that he's looking for. And so I think similarly, when you're new to commercial real estate versus someone that's more experienced, generally speaking, the more experienced person is going to be able to take advantage of a deal much faster because they have the confidence and wherewithal to be able to make a decision versus someone that's new. And someone that's new, they're more focused, and rightfully so, on not making a mistake. Okay, and the challenge with that is a few things. Number one, you're never going to have 100% of the information, right? So you just kind of have to accept that. And to try to continue to acquire more and more information, frequently what ends up happening is great deals are going to get picked off by someone that's prepared to act without all that information. Okay, so that's the first thing. The second thing is you're always going to find new information. And so even when you are in due diligence and after due diligence, you're going to continue to find more and more information. And so at a certain point, you just have to basically make a decision. Okay. Now, I'm not giving any investing advice here. I'm just describing the real world of commercial real estate as I know it, and then based on the people that I have learned from. So taking those two things into account, what are some of the rules and frameworks that you could use? All right. And these are some of the things that I kind of have implemented. And really what I want to do is hopefully help you to create this for yourself. All right. And one of the biggest things that I've really taken from Guy's writing is understanding your own personal bias for how you make decisions, and specifically how this relates to investing. And our biases evolve over time, at least they have for me. And so what I used to believe may change over time. And I was literally having a conversation with someone not long ago, invited them and had a nice conversation as it relates to investing in retail properties. And what I discovered in that conversation was fundamentally, this is my observation, is that he didn't believe in investing in commercial real estate. So no matter how, and there's no right or wrong, right? It's what you believe. And if you don't believe that investing in commercial real estate, specifically in this asset class, is going to be the right thing for you, then it really doesn't matter if you see an incredible property or not, because deep down, your subconscious, and this isn't to get all woo-woo, but subconsciously you're going to kill the deal in some way, shape, or form, and that is something I've observed as both a broker and an investor, time and time again. And that's one of the challenges. You as a new investor, just understand that when you're dealing with a seller or a broker, and they ask you, have you done a deal before? And if you have not, they are going to be nervous because there's going to be things that come up in the process of investing that could potentially derail you. So just take that with a grain of salt. So what are some of the biases that someone would have for investing? Okay, the variables are going to be, what market are you in, right? My market here in Calgary is very different than that of someone that's in Toronto or Denver or Austin or Red Deer or Winnipeg. Okay, every market is going to be different, right? What works here won't necessarily work there. How much money do you have? How old are you, right? If you're in retirement, it's going to be very different than if you're in your 40s or 30s, and maybe you're prepared to not roll the dice, but you're prepared to take on a little bit more risk versus saying, you know what, I've acquired $10 million. I don't want to lose this. Okay. So how much money you have, what's your age, what market, how much knowledge do you have? If you have never invested in commercial real estate, you're going to feel likely that you don't have enough information. You don't have enough knowledge to be able to pull the trigger and make a confident decision, right? And that's where relationships come in. So do you have good, strong relationships of people that you trust? How much time do you have to evaluate a deal? And then ultimately, what is your risk tolerance? I think this is one of the biggest discrepancies that I see, where people say, you know what, I want like 15% returns, but they are prepared to take on risk equivalent to 3% returns, right? Like they want the risk of a bond, but they want the returns of like an IPO stock. And unfortunately, the two just don't mesh. So I think that if you kind of just take some time to think about that, it would be helpful. And like I said, it evolves. And so it doesn't mean that these are written in stone. As you acquire more knowledge, you may actually be prepared to take on quote unquote more risk. Now, what are some of the rules that an investor would put into place when investing in real estate or commercial real estate? I'll give you one big one. This is something that we've had conversations on recently, and it's what's your loan to value? Like, what is the amount? So let's say you're buying a $1 million property. How much leverage are you comfortable taking on, right? CMHC, they allow you to push the envelope up like over 90%. Just because you can doesn't mean you should, right? And so some REITs, they will go much lower leverage because they want less risk, right? They are comfortable at 65% loan to value or 50% loan to value. Maybe you're not comfortable having full recourse loans, so you want less leverage. These are all rules that are for you, not for me, right? My rules are going to be different than your rules. What is the DCR? What's the debt coverage ratio? Basically, how much income, right? So let's say your mortgage is $100 a month, and your income is $150 a month, you have a 1.5 debt coverage ratio, right? What is it that you feel comfortable with? Are you going to invest in your backyard versus are you going to focus on growth areas, right? These are going to be different things for different people. Are you going to invest individually in syndications, in just your deals? Are you going to have partners, no partners? Where do you get your information, right? For me, I get my information from CoStar. I'm prepared to pay for that because I want unbiased information. If you rely exclusively on brokers who make a living selling properties, that could potentially skew the type of information that you're going to get. I think it just makes sense. I don't really need to belabor that. What is the sequence that you get in terms of your information? That was one thing that I got out of this book that was really cool. And it is this concept of a guy will actually get factual information from sources that he deems reliable versus, say, talking to management or talking to someone that maybe is incentivized to sell that stock or market it. And so just little nuances like this, you pick it up and then you say, you know what? I'm going to adopt that going forward. All right. Now, here are a few of the strategies that, up until now, I don't think I really shared them outside of my private coaching, but I'm just going to be very transparent here. And this doesn't mean that it's the only way to invest, but this is maybe one way to consider investing. And it's what I call a programmatic investor. And really it comes down to clarity, focus, and then now I'm layering in this new model, which is understanding your personal bias, right? Your emotional hot buttons. And that is something that is not cookie cutter, is never, I don't think it's going to be written in a book, but if you read a book like this, then I think what ends up happening is you start to develop and get a self-awareness of what it is that, makes you tick, how you make decisions. Okay, so here is one strategy that you could use to invest in commercial real estate. All right. So this is first a mindset. I'm going to commit to 1 year. I'm going to pick one city. I'm going to pick one asset class. I'm going to pick a deal size or range that is comfortable for me, right? No sense in talking about doing $10 million deals if you're not comfortable guaranteeing a loan of $7 million, for example, right? Or maybe you only have X dollars to be able to invest. Why not just focus on a deal range that is comfortable for you? You can always scale into the future. I would say pick one strategy, right? Are you value add? Are you core? Are you development? Like, what is it that you want to focus on? And then inside of a city, pick one, and this may be where it gets a little bit different, and you'll see why. If you're in an industrial properties, then you could probably just focus on like one industrial park. But if you're focused on multifamily or retail, you may want to focus on 2 or 3 communities that you really believe in. But just to kind of recap, for 1 year, you commit to picking one city, one asset class, one deal size, one strategy, one market area, 1 to 3 market areas. And here's why that's important. Even if at the end of that year, you realize that you don't want to invest in that city or asset class, you've built a skill set that you can take and apply to the next community or city or asset class. And It won't take you a year to figure it out. It might take you 30 days. And then from there, you do it again. And pretty soon, in like a week, you can evaluate, or in hours, you can evaluate locations, markets, properties, because you have that muscle, if you will. But often what happens is new investors, they jump around. They're in 3 different cities. They're doing multifamily. I like mixed use, maybe industrial. Show me $2 to $5 million deals, but I really want to, don't be afraid to show me a $15 million property. I love value add, but I'll still look at a core asset. Like, it's just so scattered that it's really hard to build up that level of competence to be able to make a decision very quickly. So I got to roll. I didn't realize I have a call right now. So I think that's really what I wanted to focus on. I'll get into more of this in the future. But hopefully this was helpful just in understanding how I think about investing. And like I said, if you haven't got The Education of a Value Investor by Guy Spier, I would highly recommend it. Okay, that's it. Bye for now.